Welcome to the deep dive. Today, we're tackling fixed income securities.
Yeah.
We've got a chapter here as our guide, and the mission really is to get past this idea that it's the sleepy side of investing.
Hmm.
We want to understand it properly, see what's underneath, and, well, just grasp how it actually works.
Exactly. And, you know, think of the debt market as sort of the engine of the economy.
Mm.
This chapter really shows how it links up the borrowers.
Mm-hmm.
Could be governments needing funds for roads or companies expanding.
You're right.
Links them up with investors who are looking to, put their capital to work. It's that flow of funds that kind of makes everything happen.
Okay, let's set the scene a bit. This chapter really spells out that raising money through debt issuing bonds, say it's just fundamentally different from equity, from selling ownership.
Completely different.
With debt, you've got that obligation to repay. Equity's more about sharing in the success or failure. And these bonds, they first get issued in the primary market, right? And then people trade them later in the secondary market.
That's right. And if you look at India's debt market specifically, there are a few main buckets. You've got government stuff, GSECs, T-bills, those state government bonds, the SDLs.
Okay.
Then you have bonds from public sector units, PSUs, and banks. And then there's the private sector stuff, bonds, debentures, short-term things like commercial paper. And the chapter really stresses you need solid legal rules and good credit checks for this whole thing to function properly.
Yeah, makes sense. The name itself, fixed income securities, kind of gives the game away, doesn't it?
It does.
It tells you there are these preset financial promises from whoever borrowed the money.
Precisely. The absolute core of a bond is that promise from the issuer. Two promises, really. Pay regular interest, that's the coupon, and pay back the original loan amount, the face value or principal when the time's up, at maturity.
That predictability, I guess that's a big draw for many people.
It is. And while, paying interest twice a year seems most common, the chapter points out you can find others. Annual, quarterly, even monthly sometimes.
Oh, interesting.
And then you've got the odd ones out, the zero coupon bonds. No periodic interest there.
Right. The return is just the difference between what you paid, which is less than face value, and the full face value you get back later.
Exactly. And this idea of par value or face value, it's key. That's the amount repaid at the end. Often 100 for government bonds in India, maybe 10,000 for corporates.
Except for those weird perpetual bonds you mentioned, the ones that never mature.
Yeah, fascinating things. They just, in theory, pay interest forever. No principal repayment date.
Wow, okay. The chapter also draws a line based on time, right? Money market versus capital market.
Money market is short-term, a year or less. Capital market, that's for the longer stuff, over a year. And it's interesting, a long-term bond, as it gets closer and closer to its maturity date.
It sort of becomes a money market instrument.
Yeah, in its final year, it essentially transitions, shows how things evolve. And every bond, fundamentally, has these core features. The coupon rate, the maturity period, tenure, and that principal value.
Okay, now here's a bit that might trip people up. The price you actually pay for a bond out there in the market. It's not always that face value, that par value.
Not at all.
It can trade higher at a premium or lower at a discount. And it sounds like it mostly depends on how its interest rate stacks up against what new, similar bonds are offering.
That's the heart of it. Yeah. Think about it. If you own a bond paying 5% and suddenly new bonds just like it start paying 6%.
Yours looks less attractive.
Right. So its price will probably fall below face value. It trades at a discount. But flip it. If new bonds are only paying 4%, your 5% bond looks pretty good.
So people might pay more than face value for it, a premium.
Exactly. And companies, they don't just issue one bond and call it a day. They can have loads of different bond issues out there simultaneously. Each one gets its own unique ID, an ISIN.
Like a serial number for bonds?
Sort of, yeah. And each can have different terms. There are even rules about how many can mature in the same year for one company. All these specifics, they're laid out in the bond's legal agreement, the indenture.
It's always in the fine print.
Always is. And speaking of details, the chapter brings up bonds with embedded options. These can kind of change the game a bit between the issuer and the investor.
Ah, right, like callable bonds. So the company that issued it gets the right to buy it back early.
Yep. That's usually good for them if interest rates have dropped since they issued the bond. They can pay off the old higher rate debt and issue new debt more cheaply.
But bad for the investor, potentially.
Could be. Because your bond gets called away and now you've got your money back, but you have to reinvest it when rates are lower. That's that reinvestment risk we hear about.
Okay. Then what about puttable bonds?
Puttable bonds flip that. They give the investor the right to sell the bond back to the company at a set price on certain dates.
So that gives the investor an escape route if things go sour with the company.
Exactly. Or maybe if interest rates have risen significantly, making their bond less valuable on the open market.
And the third type mentioned, convertible bonds.
Right? Convertibles. They're like a hybrid. You've got a regular bond, but it also comes with an option to convert it into the company shares, the common stock, under specific conditions.
So a bit of bond safety with a potential stock market upside?
That's the idea. So yeah, fixed income sounds straightforward, but these options show there's definitely complexity under the hood, which brings us nicely to risk, actually.
Always got to talk about risk.
Always. And the chapter makes the general point. Lower risk usually means lower potential return. So government bonds, seen as safer, typically lower yields. Corporate bonds, more risk. So they usually have to offer higher yields to attract investors.
And those PSU and bank bonds often sit somewhere in the middle?
Generally, yes.
Uh,
And the chapter breaks down the main risks into two big categories. Market risk, that's mostly about interest rate changes, and credit risk, which is all about whether the borrower can actually pay you back.
Okay, let's unpack interest rate risk first. You said prices and rates move opposite ways.
Generally, yeah, that's the inverse relationship. If market interest rates go up, new bonds being issued will pay more. That makes existing bonds with lower coupons less attractive.
So their prices tend to fall.
Right. Which means if you have to sell your bond before it matures when rates have gone up, you might actually lose money, sell it for less than you paid.
But there's a way around that. The chapter mentioned hold till maturity, HTM.
Yes, HTM. If you just hold the bond right until its maturity date, you're promised your original principal back, regardless of what interest rates did along the way. So it shields you from those day-to-day price swings caused by rate changes.
But what about those callable bonds again?
Ah, good point. If rates fall sharply, the issuer might use their call option to buy the bond back from you early.
So you get your principal back sooner than expected, but
Now you have to reinvest it at those lower prevailing rates. That's called call risk, another angle on the interest rate scenario.
and even if your bond isn't called, there's still that reinvestment risk on the coupon payments themselves.
Exactly. You get your regular interest payments, but where do you put them? If rates have fallen, you might not be able to reinvest that income at the same rate your original bond was paying. The chapter notes this is actually a bigger deal for people who do hold to maturity.
Okay. Let's switch gears to the other big category, credit risk or default risk.
Right. This is a straightforward one, conceptually anyway. It's the risk the issuer, the company, or government simply fails to make an interest payment, or fails to pay back the principal when it's due.
And corporate bonds usually pay more interest, partly to compensate for this higher risk compared to government bonds.
That's the basic trade-off, yes. But credit risk isn't just one thing. There are nuances, like downgrade risk.
What's that?
That's when a credit rating agency, like Moody's or S&P, lowers its rating on the issuer after you've already bought the bond. Maybe the company's financials worsened.
And that spooks the market.
Often, yes. A downgrade signals increased risk, so the bond's price is likely to fall. The chapter mentioned the ILNFS case as a big example of this in India.
Right, I remember that.
Then there's spread risk. The spread is the difference in yield between a corporate bond and a government bond with a similar maturity.
Okay.
That spread reflects the extra return investors demand for taking on the corporate's credit risk. But that spread isn't fixed. It can widen if the market gets nervous about the economy or that specific company, or narrow if things look better. That fluctuation is spread risk. And ultimately, the size of the spread reflects the perceived default risk. Really risky bonds, junk bonds, have huge spreads because the market sees a significant chance they might default.
Makes sense. What else? Liquidity risk.
Yeah, liquidity risk. Can you sell your bond quickly if you need to without taking a big hit on the price? Some bonds trade very actively, others don't. Longer-term bonds or bonds from less well-known issuers can sometimes be harder to sell quickly at a fair price.
So government bonds or bonds from top-rated companies would generally be more liquid.
Generally, yes. Lower impact cost, as they say.
Yeah.
Then, for international investors, or if you invest in foreign currency bonds, there's exchange rate risk.
Changes in currency values affecting your return.
Exactly. Your bond might pay out in dollars, but if the dollar weakens against your home currency, your return is lower when you convert it back. The chapter mentions Masala Bonds, Indian companies issuing rupee bonds overseas where the investor takes on the currency risk.
Okay. We also can't forget inflation risk, right?
Definitely not. The risk that your bonds return doesn't keep up with the rising cost of living. Your fixed interest payments buy less and less over time.
Fixed rate bonds are most exposed here.
Yes. Floating rate bonds, where the interest adjusts, or those inflation index bonds we mentioned earlier, offer some protection against this.
Anything else on the risk front?
Well, the chapter briefly touches on volatility risk, mainly relevant for bonds with those embedded options as the value of the options themselves can change. And political or legal risk, maybe a change in tax laws affecting bond income or some unexpected government or issuer action.
And finally, event risk, those black swan events.
Yeah, the big unexpected shocks, pandemics, financial crises that can hit the value of almost everything, including seemingly safe bonds.
So quite a minefield, even in fixed income.
It just shows you need to understand what you're buying. Now, maybe we should talk about how bonds actually get priced.
Yeah, let's do that. How is the value determined?
Fundamentally, the chapter explains, a bond's price is the present value of all the money it's expected to pay you in the future.
Meaning those coupon payments and the final principal repayment?
Exactly. You take all those future cash flows and discount them back to what they're worth today.
And that brings us back to par value, the face value repaid at maturity. Like 100 or 10,000 bonds are quoted as a percentage of that, right?
Correct. A price of 105 means 105% of face value. 98 means 98%.
And you said earlier, as a bond gets closer to maturity, its price tends to move back towards 100, towards par.
That's the general tendency, yes. Assuming the issuer is expected to pay it back, of course. Also, remember those short-term things like T-bills or commercial paper? They're often issued at a discount. No coupons. Just buy cheap, get face value back. The difference is your return.
So calculating the price involves discounting those future cash flows. Using what interest rate?
Using the current market interest rate, or yield, that investors demand for bonds with similar risk and maturity. That rate is called the yield to maturity, or YTM.
Okay.
The bond's price is essentially the sum of the present values of all its future payments, where each payment is discounted using that YTM. It reflects the time value of money. Money today is worth more than money tomorrow.
And the chapter mentions you can even use Excel, like the price function, to do this calculation. It gave an example where if the bond's coupon rate is the same as the market's required yield, the YTM, the price comes out at par, at 100.
Exactly. That illustrates the relationship. Coupon equal YTM means price is usually around par. If coupon YTM, the bond is attractive, price goes above par, premium. If coupon YTM, it's less attractive, price falls below par, discount.
Okay, so where does the actual return for a bondholder come from? What are the sources?
The chapter lists three main ones. First, obviously, the coupon interest payments you receive.
Yep.
Second, any capital gain if you sell the bond for more than you paid, or potentially a capital loss if you sell for less.
Right.
And third, the income you can potentially earn by reinvesting those coupon payments as you receive them.
Got it. And how do we measure these returns? The chapter mentioned a few yield measures.
Yeah, some simple ones first. Coupon yield is just the annual coupon divided by the face value. Easy peasy. An 8.24% coupon on a 100 bond has an 8.24% coupon yield.
Okay. Then current yield.
Current yield is a bit more market-focused. It's the annual coupon payment divided by the bond's current market price. So if that 8.24 coupon bond is trading at 2 toru,
You divide 8.24 by a 103.
exactly, which gives you a slightly lower yield, around 8%. It reflects what you're earning relative to the current cost of buying the bond.
Does it matter how often the coupons are paid? Like semi-annually versus annually?
It does, a little. Getting paid more often, say semi-annually, means you can reinvest that money sooner. So due to compounding, the effective return is slightly higher than if you just got paid once a year.
Okay. Now, what happens if you buy or sell a bond between coupon payment dates? There's this idea of clean versus dirty price.
Right. The price you usually see quoted in the market is the clean price. It doesn't include any interest that's built up since the last payment.
But the buyer actually pays more? The dirty price.
Yes. The dirty price includes the clean price plus the accrued interest, the interest earned by the seller from the last coupon date up to the sale date. It makes sure the seller gets compensated for the interest they earn while holding it.
Okay, that makes sense. The chapter mentions some steps to calculate the price between dates, too.
Yeah, basically valuing it at the last coupon date, calculating the future value up to the settlement date, and then adjusting for the accrued interest. It also reinforces that inverse price-yield relationship, longer maturity and lower coupon bonds are generally more sensitive to rate changes.
And it recaps that link. Coupon rate versus market yield determines if it's par, discount, or premium.
Mm-hmm. And it even circles back to those perpetual bonds. No maturity. Their value is just the annual coupon divided by whatever rate of return investors currently demand for that kind of perpetual risk.
And then the big one, yield to maturity, YTM.
Yes, YTM. We touched on it as the discount rate, but think of it as the total return you get interest, principal repayment, assuming reinvestment at the same rate if you buy the bond today and hold it right until it matures. It's like the bond's internal rate of return.
Calculating it sounds tricky, though. Not always simple division.
Not usually, no. It often involves trial and error, or using financial calculators or software like Excel's yield function. That function needs several inputs: settlement date, maturity date, the coupon rate, the current price, the redemption value, usually par, how often coupons are paid, and something called the day count basis.
Day count basis. The
Yeah.
chapter had a box on that.
Yeah, box 9.1, it's just a specific convention used to count the days for calculating accrued interest. Different markets use different rules, like 30 days per month, 360 days per year, or actual days in the month, actual days in the year. You need to know which one applies.
Seems technical, but important for accuracy.
It is. The chapter also briefly mentions effective yield, the annualized yield, considering compounding, and yield to call or yield to put, which are like YTM but calculated to the first call date or put date, respectively, not the final maturity.
Okay, comprehensive. Let's shift focus slightly to the yield curve. What is that telling us?
The yield curve is basically a snapshot, a graph showing the relationship between bond yields and their time to maturity, usually for bonds of the same credit quality, like government bonds.
And it typically slopes upwards, higher yields for longer maturities.
That's the normal shape, yeah.
Yeah.
Investors generally want more compensation for locking their money up for longer due to risks like inflation uncertainty over longer periods.
But it's not always like that.
No, definitely not. The shape reflects the market's expectations about future interest rates and inflation. The chapter mentions 4 typical shapes: normal, upward sloping; inverted, where short-term rates are higher than long-term rates.
That's the one people say might signal a recession.
It's often interpreted that way, yes. Then there's a flat curve, where yields are pretty much the same across maturities.
Yeah.
And sometimes a humped curve, where medium-term yields are the highest.
Interesting how much information is packed into that curve. Now, another key concept, duration. What's that measuring?
Duration is super important. It measures how sensitive a bond's price is to changes in interest rates. Think of it as a measure of interest rate risk.
Okay. There's Macaulay duration.
Right. Macaulay duration is a bit technical, but it's the weighted average time it takes to receive the present value of all the bond's cash flows, coupons, and principal. It's measured in years. A higher duration means the bond's price will likely move more when interest rates change, more volatile.
Like a longer lever. A small change moves the end more.
That's a great analogy, yeah. Calculating it involves finding the present value of each cash flow, weighting it by the time until it's received, summing those up, and dividing by the bond's current price.
And duration increases with maturity, but not forever, and it's usually less than maturity.
Correct. It increases, but at a decreasing rate, and it's always less than or equal to the bond's maturity. Only for zero coupon bonds are Macaulay duration and maturity the same.
Then there's modified duration.
Modified duration is often more practical. It gives you an estimate of the percentage change in the bond's price for a 1% change in interest rates. It's derived from Macaulay duration, usually slightly lower. And the chapter just flags convexity too, which refines the duration estimate because the price-yield relationship isn't perfectly straight.
Okay, duration tells us about price sensitivity. Now let's zoom in on the money market. Very short-term stuff.
Ultra short-term, yeah. Overnight up to 1 year. It's where banks, institutions, even corporations manage their immediate liquidity needs, borrowing or lending for short periods. It's critical for the smooth running of the financial system and for the central bank, the RBI, to transmit its monetary policy.
Who are the main players here?
Banks are huge, obviously. Financial institutions, insurance companies, mutual funds, those primary dealers who help auction government debt, NBFCs, big corporates, lots of players managing their short-term cash. And the chapter lists the main instruments.
Right, things like call money that's overnight between banks, notice money for a few days, term money for longer periods up to a year.
Exactly. And repos, repurchase agreements. Basically, short-term loans secured by collateral, usually government securities, market repo, TREPs, or tri-party repo, but sometimes even corporate bonds now.
And short-term government paper like cash management bills and treasury bills?
Yep. CMBs are super short, under 91 days, for temporary government cash needs. T-bills are 91, 182 or 364 days, issued at a discount.
Plus corporate instruments like commercial paper, CP, and certificates of deposit, CDs.
Right. CPs are short-term unsecured IOUs from companies. CDs are issued by banks and financial institutions, kind of like large-scale fixed deposits, but tradable. The chapter gives a neat summary of each.
Okay, let's pivot to the government debt market specifically. The chapter says it's the biggest and most active part in India.
By far. It's grown a lot thanks to government and RBI efforts. It serves multiple roles: funding the government, setting benchmark interest rates for everything else, and being a key tool for RBI's monetary policy actions.
And the main holders are institutions. Banks needing them for SLR rules, primary dealers making the market, insurance companies, and the RBI itself.
Those are the big ones, yeah. And the chapter details the different types of government securities, all considered very low risk, each with its unique ISIN.
We already mentioned T-bills and CMBs for the short end. What about longer-term dated securities, GSECs?
Those are the long-term bonds, maturities from 1 year out to, well, 50 years now sometimes. Most pay a fixed coupon twice a year. That's the standard fixed-rate bond.
Like 5.77% GS 2030, that tells you the coupon and maturity.
Exactly. There are also floating rate bonds, FRBs, where the coupon resets periodically based on some benchmark, though they haven't been as popular. Zero coupon bonds we've discussed. India also experimented with inflation-linked bonds, capital indexed and inflation indexed, but they aren't actively issued now. Same for bonds with call or put options.
What about special securities?
Those are issued for specific things like paying subsidies, food, oil, fertilizer, or recapitalizing banks. They might have slightly different terms, like maybe not counting for SLR, but offering a higher coupon.
And strips. That sounds interesting.
Strips are cool. It stands for Separate Trading of Registered Interest and Principal of Securities. You take a regular GSEC, and you kind of strip off each individual coupon payment and the final principal payment, creating a whole series of zero coupon bonds from one original bond.
Why do that?
Good for investors who want a specific maturity date with no reinvestment risk along the way, like pension funds or retail investors. Then you have sovereign gold bonds, price linked to gold, plus a small fixed coupon, and savings, taxable bonds for retail, with floating rates. And finally, don't forget state development loans, SDLs bonds issued by the state governments.
Right. Also considered quite safe and used for SLR. Okay, now the corporate debt market. Smaller than the government market in India, you said.
Yeah, significantly. Demand is mostly institutional and regulations play a role. Plus, companies often find it easier or cheaper to just get bank loans or borrow overseas. But it is growing, with more focus now on transparency and building infrastructure.
What are the hurdles?
Secondary market trading is still mostly between big players, not as easy for individuals. And the clearing infrastructure isn't as developed for retail platforms. Key players here are the issuing company, the debenture trustee.
Who looks after the bondholders' interests?
Exactly. Compulsory if the maturity is over 18 months. Then you have the qualified institutional buyers, QIBs, banks, MFs, insurance, and retail investors, plus the stock exchanges where these bonds can be listed.
And the instruments, company deposits.
Yeah, those are like fixed deposits with a company, not a bank. Unsecured, 1-3 years usually, higher rate maybe, but riskier and not really tradable securities. Then actual bonds and debentures, longer term, can be secured or unsecured, infrastructure bonds for very long projects. And yes, corporates can also issue inflation index bonds.
Okay, finally, the chapter covers small saving instruments, government-backed schemes.
Right, designed to encourage regular saving, mostly through post offices and some banks. They carry an implicit government guarantee, making them very safe.
Starting with bank fixed deposits, FDs. We all know those.
Pretty standard. Fixed term, fixed rate, insured up to 5 lakh. Rates vary, penalties for early withdrawal sometimes. And importantly, those 5-year tax-saving FDs under Section 80C.
Then there's a specific floating rate government bond.
Yes, launched in 2020. Interest resets every 6 months based on the NSE rate plus 0.35%. Taxable interest available in DEMAT form for residents.
And then the classic small savings schemes, PPF.
Public Provident Fund. Great long-term 15-year retirement tool. Tax benefits, 1 per person.
NISM.
National Savings Certificate. 5-year maturity, interest compounds, also tax benefits under 80C as interest is deemed reinvested.
SCSS for seniors.
Senior Citizen Savings Scheme. For age 60 plus, good rates. Available at post offices and banks.
And other post office schemes, POMIS, POTD,
Yeah, the monthly income scheme, PO but here for regular income. Time deposits, POTD, like bank FDs but at the post office, including a 5-year 80C option. And recurring deposits, RD for disciplined monthly saving.
KVP.
Kisan Vikas Patra. Doubles your money over a set period, interest tax as it accrues, no upfront tax break.
And Sukanya Samriddhi for girls.
Yes, for girl children under 10. Long-term savings for education or marriage also gets the ADC deduction. The chapter lays out the basics for all of them.
Wow. Okay. That really was a deep dive into fixed income. We went from the absolute basics of the debt market right through pricing, risk, yield curves, duration, and then the whole range of instruments, from government bonds down to small savings.
We covered a lot of ground, and I think, some key things really stand out. That inverse relationship between prices and interest rates, absolutely fundamental. And realizing that risk isn't just about default. There's interest rate risk, reinvestment risk, liquidity, inflation, a whole package.
Yeah, and understanding that a bond's price really just reflects the present value of what it promises to pay back in the future. That discounting concept is key.
Definitely. And seeing how the yield curve shape can offer clues about market sentiment, or that duration, helps quantify that price sensitivity. It adds layers to the understanding. Plus, just the sheer variety, especially in those government-backed small savings schemes, there really is something for almost everyone.
Absolutely. So hopefully for you, our listener, this gives a really solid but hopefully not too overwhelming picture of this crucial asset class.
Yeah, the goal was clarity. So as you think about your own investments, your own financial plans, maybe consider how this stuff fits in. How does the risk-return profile of different bonds align with your goals? How sensitive are you to interest rate changes? What role could some of these safer government-backed options play?
Good questions to ponder. That trade-off between risk and return is always central. And maybe what other questions does this raise for you about specific bonds or how these markets might evolve? Plenty to think about after exploring the world of fixed income.